Welcome everyone. My name is Kamal Manocha. I represent PMS AIF World. Like every Friday, the rhythm we started way back in 2020. Today we have Mr. Nilesh Doshi as one of our speakers. Nilesh needs no introduction, but for the sake of it, I will quickly take 30 seconds to introduce him. He brings with him around 3 decades of experience. Had founded Green Lantern way back in 2017. At a peak of last bull run. It was a very difficult time for first 3 years. Despite that, the returns have been very good throughout alpha focused strategy. The strategy which is not focused on growing assets, but is absolutely consistently focused on clients and clients' money, and that's what makes it very very unique and different. Nilesh, is a very, I would say, avid thinker, and we have seen that in his returns. And this webinar is more about understanding what is way forward, because we are sitting in the environment which is definitely quite complex for us to comprehend. Earnings season is going on. We will also cover the same, because earnings is also a matter of one's comprehension. As per some analysts, some results are good, but some others sees them as bad. It's a matter of perception, and hence perspective is important. And as I said, Nilesh brings with him 3 decades of experience, and his returns, I'm not quoting numbers, but it's like excellent. And that is where, I will myself be keen to learn his view, perspective on way forward. Nilesh, formal welcome to you to this webinar. I remember, hearing you last year in October when we had our physical event in Bangalore. There were 10 speakers, 9 were optimistic, but you were realistic. And maybe to an extent at that point of time, you were not optimistic, if I may say. And exactly same happened, since October, things the way they have unfolded. We actually kind of, realized that whatever you were saying then was making sense. But obviously, investors were at that point of time questioning that why you're sitting on cash, why you have taken cash call. Even today, you're holding around 45% cash. We'll come to some of these questions maybe in the later part of this webinar. But I wanted to open with your, I would say, perspective right now, on the markets.
Yeah. First of all, Kamal, thank you for inviting me on this discussion. And thank you for your very nice and kind words, although it's all efforts which we have to continue to put it into the market. Just a small disclaimer that whatever we discuss today, I think we should take it as our observation and view and not a recommendation, because currently we are in the world which is extremely volatile and geopolitically becoming sensitive, with new tangent adding into the geopolitical scenario, that is India-Pak situation. Having said that, let's go back to October. I think you started with that is the reason for us to be not very optimistic or realistic during October 2024 was, I don't think at that time even Trump was ahead in the race. I think he was second at that time. And trade war was not at all in hindsight. And then now the new India-Pak was never in the mind. And in spite of that, we were not optimistic purely because of the economic data which were not supporting the valuations which the market was holding in during October. After that, I think we have seen a lot of changes in the world. We have Trump taking finally is with a thumping majority. Then come February and then April, we have seen a trade war, which has been very, highly volatile trade war, I would say. And then recently we have this new geopolitical issue which has cropped up. So to honestly, if someone wants to look at in a very short term, I don't think anyone has the answer that how the market would behave. Because it's going to be very volatile and extremely narrative and news driven. But the only attempt we should make is that how do we look at a medium to long term? And in that case, we need to then go back to two scenarios. One is what's happening on the macro side globally, and then what is happening on the micro side in terms of the revenue and earnings growth. So macro, we all know that geopolitical tension and the trade war will definitely have a slowdown which we are seeing in especially the developed world like Japan, Europe, and we have seen volatility in across currency and the commodity, including the metals. That would definitely have an impact on the economic growth of Europe, Japan, and maybe later on into US. China also has, because of trade war, will have definitely some impact on their economic growth. Although you can't rely on the data, but yes, we believe there will be a severe impact to China on the economic side. So all these do not suggest very good for us as far as our exports are concerned. And we've seen the last 3 years, just I'm repeating, is that the exports growth was flat in our country for last 3 years on a dollar terms basis. If you look at the salary wage growth of corporate employees, which were about 20-25% in 21-22, have come down to 5 to 6%, which is very meager. And that's what we are seeing the impact on FMCG, the first impact which comes on FMCG. And then we had a good capital goods and defense cycle, which now probably again we are seeing because of trade war, the capital goods cycle is likely to slow down, especially in certain sectors. So overall, the global macro is not very supportive of a really good growth. But at the same time, we believe that India still is a better place in the world. If this India-Pak situation dilutes or settles down, which we don't know what's going to and how it's going to take the turn. But assuming that over the next couple of months, if it slows down, we will definitely have some impact on our GDP growth because of this also. But still, one can look forward beyond that, that how the Indian GDP growth rate will take place. Coming to micro, if you look at the Q4 numbers, almost end of April, if I have the data, out of 500 companies, about 150, 60 companies have reported earnings. And you will find that cumulative revenue growth is hardly 5% on a YOY basis, and even earnings growth is 5% YOY. So you don't see a very good picture in terms of supporting valuation at which the market is. Even if we take the market at let's say 1,000 and odd earnings today, the market is placed at about 20 times, 21 times. Now, what is critical at this juncture is that what is going to be the earnings growth going forward in FY'26. Now, so far we have not seen any major earnings upgrade has come from any large houses, but we believe that all this trade war, slowdown in Europe and Japan, China, and now with India, we will definitely have a reduction in earnings going forward, and market will have to recognize that in terms of valuation and in terms of finally the indices level. Now, keeping that in mind, we still believe that market is not yet made a base for a next upward move. Can market remain under pressure or downwards? There is a high possibility because all these earnings and whatever downside we see in case from Q1 or Q2 onwards will probably reflect in the market down the line, because as of today, market is holding on maybe in two happenings. One is the dilution from US in terms of the tariff war, and probably market is believing that India-Pak situation will dilute to a larger extent over next 1 to 2 months, especially because we are a much larger economy, and the Pakistan ability to carry this forward for a longer period of time is much lower. So keeping that in mind, market is probably trying to hold at this juncture. But we believe that on a broader level, if we see at Nifty indices level and a broader market, there is a possibility that market will remain with a downward bias for even a couple of more quarters till the tariff situation stabilizes, the world restructure its supply chain, and then we don't see much larger inflation in US. Therefore, we expect Fed probably to kick in with interest rate cut if that happens. And the liquidity what RBI has provided into our system along with repo rate. So this liquidity may pan out positively with little lag, say 1 or 2 quarters. So all this then will help market to relook at fresh over, let's say, after 1 to 2 quarters. So this is on the broader scale in the market. This is what view we hold. Now, I'm sure the question you would have is then how do we navigate from here, or should we look at investment or not? So I'm probably preempting your thinking based on whatever I've said is. So what we have been of the view from here onwards is that market will reward wherever there is going to be revenue and earnings growth, and which we have seen from Q4 numbers. You see, there is one coffee company which gave really good numbers on YOY. The stock has been up 20%. Today, L&T gave good numbers. The market has taken it positive. Some API company gave very good numbers on a YOY basis, and structural change in the business, the stock is rewarded positively. So our view is that the market, we are definitely not in a scenario where equity as an asset class is being challenged. And therefore, we will have to work towards finding stock-specific actions and stock-specific investment, which should be our strategy going forward. So maybe I can answer more to any questions on this if you have.
Sure, Nilesh. So, around October, you had book profits out of some of the stocks like Zaggle, etc., in your portfolio, and like others, and you had increased cash. Now, when we are seeing quarterly results, I am also, seeing some of those company results. Their results are like relatively, better, and the valuations have also fallen because those stocks are down 50%. But still, you're holding on to cash. What is the reason for that?
No, so what you are seeing is probably April, but in last 1 month we have almost invested about 8 to 10% in the market, and we are seeing a lot of stocks which is coming on our radar for study, meeting the management, do the analysis, and then invest into it. So going forward, we are relatively comfortable that we should be able to invest a really good size of portion. Maybe I don't have the number, but maybe additional 15-20%. For sure, we should be able to do it post let this volatility get over because of war. However, we would remain more focused on the revenue and the earnings growth. And we see a lot of businesses will do better irrespective of global trade war or irrespective of this local geopolitical issue, or irrespective probably of some of the government fiscal consolidation policies, etc. And we are finding such businesses today to invest. And we have already started investing, and I think we should be able to invest larger sum over next couple of months. We are very comfortable with that.
Sure. So Nilesh, let's maybe do maybe short answers to some of the questions because I have a long list, but absolutely good. Your strategy, which is growth strategy, we call it growth. We don't call it value strategy, and because we come across this question often. The underlying, I would say, ideology in terms of selecting PSUs and some of the, I would say, less discovered businesses where you invest like early investors, that ideology or philosophy is like more of a value investing. But why do you call it growth approach? Why the name is why Green Lantern Growth Fund?
Very nice question, and I think you are opening up a basic definition of value versus value plus growth. So I think we are not pure value investors whereby you buy a business just because it is available at 4p, 6p, and you don't have a visibility of whether the business is going to grow in terms of revenue and earnings both, either or and both. So we are not that kind of investors. We would like to buy a business at a value. This value is not defined in terms of PE multiple. This value is more defined in terms of buying the business at that valuation, whether it makes a sense, along with whether you are uh, close to an uh, change in the revenue and earnings on the positive side. Now that defines our strategy as growth. We could have said value plus growth, but that's not the way we believe it. We don't mind buying a business which is probably at infinite multiple. I mean, if it is making a loss, it would be at an infinite multiple. We don't mind buying that business provided we have a real handle on the business, the opportunity in the business, the point of time at which that business is placed in the economy, and you see really a good revenue and earnings growth on a either a sustainable basis for a couple of years, or probably the business is revising for good for medium to long term. And once we get all these parameters right based on our understanding of economics, our understanding of sectors, our understanding of value chain in every sector, going deep dive into competitors, the peers, the global competition, and then only we look forward investing into those businesses. So this is clearly, directly, indirectly, it is a growth strategy, but growth strategy at a point where the business is probably uh, not famous, or probably people have forgotten that business because of the past cycles. The business would have gone into some kind of a paying process, and therefore the stock should be available to us at a extremely favorable risk reward ratio, because this is a fundamental principle with which we invest into equity. We believe that in equity, we are not a momentum investor for sure. We don't believe that if we buy a business at 60 multiple and somebody will relieve us, or we get an exit at 80 multiple. No, we don't do that. But we would definitely want that we should be able to buy, or we are prepared to buy that entire business at that value, since the cycle for that stock or the company or the business is changing in near term. And therefore, truly it is a growth strategy, uh, but buying at very favorable risk reward, where your risk should be minimized. And if reward happens, if your all hypothesis of investment materializes, the reward is generally much higher than one expect. And that is a strategy which we have been working since long, and that has actually helped us navigating the market over the last 5 years, and probably able to manage to give this kind of return.
Sure. So, what are those, I would say, sectors, in the present context when things are definitely turning around and some areas are losing growth, some areas are gaining growth. Like in the last bull run, it was maybe all about PSUs, defense, railways, power, and you kind of, chose to invest in some of those, I would say, contrarian uh, bets. And
Right.
likewise, what kind of, I would say, point are we at, and where is your inclination going to be from here onwards for seeing such multifold growth?
Nice question. So let me take you to last 5 years first. Is actually, if you go from just beginning of COVID, which, and then we had a lockdown. I mean, within few months, what we have seen is the first sector which has moved was pharma, and then followed by API in pharma business. And thereafter, if you observe since 2020 mid or 2021 onwards, I think in our view, every sector has had given a phenomenal run up over the last 4 years. I don't think there was any sector which has been left out. Starting with chemicals, then textiles, then uh, auto did little later, but I think you take every defense, railway, then engineering goods, capital goods, finally even hotels, hospitality. So every sector, and lately even the banking. So every sector in our view has had run up over last 4 to 5 years. And in every sector you have seen multi-fold return in many businesses or many stocks. Therefore, in our view is that will that repeat going forward? We are not of that view, because typically in market, apart from fundamentals, revenue and earnings growth, there is also something called positioning of the stocks. Now, all those stocks which have run up phenomenally over last 4 or 5 years would have been placed across in the market and largely in every portfolio, or it is distributed across portfolio. Therefore, expecting those stocks to do well only and only if, instead of a sector, maybe some company within that sector can do very well. And therefore, our view going forward is going to be that, as I said earlier, is that we don't expect broader market to do very well. That doesn't mean that broader market will not give return, but it is not something which one would like to invest into equity market for that 10-15% kind of a return, because then the timing matters substantially. What we believe is that, therefore, the approach going to be is for sure a bottom-up approach, not a top-down, which we have seen in last 4 or 5 years. When I say top-down, I'm sure investors understand that you identify a sector which is about to explode, or which is at an inflection point, which is coming out of a massive pain point over last few years. And then you start investing into the leader of that sector, followed by the medium quality business, and then eventually you'll end up investing into the lowest level of business in that sector. And then with such a huge tailwind in that sector, you make lots of money. That kind of scenario is already played out in last 4 or 5 years. And therefore, you are seeing on the other side that government too is also a fiscal consolidation path, with now some spending coming on the defense side also. What we strongly believe is that the going forward is going to be a stock pickers market. It will be largely a bottom up, and this bottom up could be in every sector. So like if L&T has, I mean, L&T is not a recommendation, but say if L&T has done phenomenally well, and if the revenue and earnings growth is known to the investors, or if somebody can extrapolate a good revenue and earnings growth, probably a stock can do well. So the whole approach in the market is going to be a stock specific driven, and it would be like doing a deep dive in the sea and finding something very good, rather than finding a big sector and then just follow the sector. So this is what is going to be the approach. And therefore, I don't see broadly a sector would make a big move, except defense has already done a really good move. Maybe some specialty chemical businesses can do well, but it's not going to be the broader and larger number of sectors are going to follow the pattern which we have seen between 2020 and 2024.
Sure, Nilesh. So, now you will be shifting your gears and more maybe following a blend of, say, top down and bottoms up, with maybe more, I would say, focus on bottoms up, because it is more of an opportunist style of investing, right? In that, what will be your target universe of businesses in terms of large, mid, small, or how will you ultimately create the construct? Because mostly your PMS is viewed as a small mid cap biased fund. So from that point of view, I want you to kind of align the investors' expectations.
Again, a very nice question, but you have answered yourself. Is that if our expectation or our hypothesis is that broader market is not likely to do a good reward, on a Nifty or index level also, we don't see a major happening. Therefore, finding a large cap going to give you a reward, which it has given in last 5 year cycle, where even large caps have gone 3x and 5x. I don't think it's likely to happen in this cycle. If it happens for some reason because of, let's say, some liquidity coming from US and much dilution in the trade war policies and in pump priming the economy by, let's say, money printing and bringing the rates down, we will change. Definitely, we will look in a much faster way in the different direction. But currently, therefore, by design, you will be able to find businesses which are into small and mid cap category and largely into small cap category. And these are, when I say small cap, these are not SMEs, or these are not those 100 crore or 200 crore revenue kind of businesses. Obviously, these are sizable businesses, but who have not performed in the past cycle, or who have come down from its recent high, and then the business is now turning for good in terms of earnings and revenue growth. So you will get these multiple possibilities, permutation, combination kind of businesses, and opportunities will be there. Of course, it's not going to be like what has happened in the past cycle, that every sector and then many businesses in every sector have done well. This time it's going to be relatively more selective, more deep dive you have to do to understand the business. You have to have better handle on the every value chain of the business, not just there is a tailwind in the sector. And then whatever call which you take, you have to have really good work done on the company and the business. And then in the past cycle, just to add, you have seen stocks giving reward at much faster pace. You have seen stocks multiplying 5x and 10x within a period of 1 year and 2 years, because concentrated demand along with very high change in the earnings or EBITDA margin and all that resulted into a fast movement, which is again not likely to happen. And therefore your stock has to be for definitely a medium to long term perspective kind of analysis which we need to do. And that's what we feel comfortable that we should be able to find at least few businesses in this entire spectrum of listed companies.
Sure, Nilesh. There is this, largely narrative which has been kind of built uh, against small caps and mid caps in terms of valuations being very high. Some fund managers are sitting 80, 90, 100% on cash, and maybe they are waiting for, a very deep correction. One cannot predict, obviously, any uncertain event, which if happens, correction would definitely happen. But fundamentally, it's like over last 3 quarters, 9 months, when markets, specifically from the point of view of mid and small caps, has kind of been correcting. We have seen correction going on, and broadly, I think it is like 30%, across mid and small cap. So at this level, at these levels of valuations, obviously it is stock specific. You have to be opportunist. You have to invest into a business where it is blend of growth and value, and you cannot miss growth at all. But what is your, feeling overall? Fundamentally, are we rightly valued, or those fund managers who are like sitting 90% on cash? Why is this disconnect? Because this narrative is something which is keeping a lot of investors confused, because there are a lot of investors who are sitting on liquidity. They are creating no new liquidity, but they are not putting that money in equity, because those thought leaders and those fund managers, kind of, when they meet with these investors, they kind of say, you don't know what's going to happen. Markets are going to fall like anything. You either buy gold or sit 100% on cash, or maybe have your asset allocation more skewed towards debt or fixed income. Obviously this is something which is fundamentally a big issue. It's like either we are wrong, or we do not know how to advise clients in this matter. Obviously we want to only understand your perspective, because why I'm asking this question to you, because you're also sitting 50% in cash broadly, but you're not 100% in cash.
Yeah, so we come from. I don't want to comment like whether why someone is on 100% cash, because the reason and the extrapolation what they may be doing based on their experiences may be right or wrong. No one knows about it. A second is that we come from a perspective that we are or anybody else who is running an equity portfolio. I think that as I said, it is an equity portfolio, which means that any investor who comes is wanting to invest into equity. And therefore, that investor is by design, and the fund manager by design are aware that equity always is a risk asset. Therefore, can you hear me? Are you there? Sure. So uh, equity has always remained a risk asset, and therefore, anyone who wants to put into equity is fully aware that there is going to be some risk associated with it. Now, when you said some fund managers are looking at 90-100% cash, there are large number of fund managers who are probably 90% invested. And then those fund managers and pundits are also talking that there is no fear in the market and market is going to go ballistically up, or maybe market will keep making newer and newer highs. So these kind of perceptions are always remain, and the fund manager's strategy has to be unique, and therefore the market accepts and absorbs all kind of fund management strategies. We are not against any individual or any kind of fund management strategy. Now, why we come from a strategy that we were very discomforted at in October period, because extremely on the valuation side. Okay, and we still believe that valuations on a broader market are expensive. There is no doubt about it. But what we have observed from the market is that globally also, if you see, equity as an asset class is behaving little differently this time. Now, there could be many reasons to that. And therefore, what we feel that, are we in a phase in the world where you sell off equity and put 100% of your wealth into an asset class? So you are left with only 3 asset classes. Would investor who has large amount of wealth or free capital would put everything into fixed income, or will put everything into real estate or gold if he doesn't want to put into equity? Correct? And there you have a fundamental question, is that in the global world, especially in the developed world, who are running a massive fiscal deficit, Europe and US, they will have to come out with fixed income, I mean the treasury paper every year. So obviously, either you become the largest borrower in the world, and therefore just to sustain your economy, or you have to resort to some kind of liquidity printing to absorb those kind of issuances. And therefore, the whole world, I mean, every investor in the world understands that this is not a sustainable model. A. Real estate is definitely, I don't think anyone now believes that it's going to be a great investment to put your entire wealth. And then finally, gold is not a commodity where you can put 100% of your money. I mean, you can't have physical gold at your home, even if it is like, or even if you buy ETF, there is no ETFs available to absorb entire $4 trillion of our market cap. Therefore, this is one part. The second part is that India per se, we don't expect that India is going to be in a very bad economic growth pattern. Yes, this latest issue has changed and created a fear in people, and we really don't know how this war will take turn. And therefore, yes, on the near term, we need to be very cautious and observant that how it is unfolding. But assuming everything, it's not going to be good relation going forward for sure, and there could be a very high tensed scenario on the border going forward for a longer period of time. But if it is not getting escalated into a full scale happening something, then India and with good relationship with US, we are working fast to get into the trade agreement. We have signed an FTA with UK. We may get into another FTA with Australia soon, and followed by probably Europe. So India, even if we slow down, we are not in a scenario today where we should be extremely worried that we're going to go down to 2, 3, 4% kind of a GDP growth rate. Yes, your expectations, which were 12, 13% nominal growth built up a year and a half ago, that you may bring it down to 10%. And then if the world economic slows down further, you may bring it down to 9.5%. But then whenever an economy which grows even at 9 or 10% nominal growth rate, for on a $4 trillion your economic size, you're adding at least 10% to GDP every year. And then in a scenario like this, Kamal, you will always find or you will always get few businesses which either because of the product or because of the company who has expanded and ready to take those additional demand, you will get opportunities in the market. You may not have many large opportunities, what we have seen in last 5 years, but we are not of the view that you will have zero opportunity, therefore you sell off everything and sit on cash. And that is the reason that, in fact, if I remember, I was the first one to call you and say that, Kamal, maybe we can look differently the market from here. And the only reason is that if you still are, I mean, even if I have to put, I don't think we are excited that Nifty will do something great or the broader market will do something great. But what we are hoping and comfortable is that you should be able to find businesses which will give you definitely a better return than the overall market. And obviously, our attempt should be to have an absolute return. I mean, that's the kind of pain and effort which fund managers will have to put in. So that's what the strategy which we want to apply for. And that is the reason that we are not saying that we would exit equity as an asset class altogether.
Sure, Nilesh, you have addressed it, I think, quite aptly. Now, moving on to the deep diving of FY26 and way forward. In terms of the overall expected growth in earnings and how the earnings from where earnings are going to come from. In terms of which is like your common sense. For us, it could be our deep dive or knowledge, but because kind of this is what you have been doing every moment of the day. I want to understand from you, like you have been focused on earnings were slowing down, valuations were high, you took part cash call, but now obviously you understand it's an equity portfolio and we have to keep discovering opportunities. You were doing top down, now sector and themes oriented multifold opportunities may have reduced, but yes, business is something that are something that you are kind of seeing. I have seen you making money in stocks like Suzlon, Sangvi Movers, and I don't want to talk about stocks. But yes, if you want to talk about stocks with particular disclaimers that this is for education, I want to understand, what type of businesses are the ones where the earnings are going to come from.
So, as I said, Kamal, if you look at any cycle or and during the cycle or this kind of a scenario, always revenue and earnings growth from demand, or there is a supply constraint. Either of the scenario has to be played. So going forward, as we see, what we are saying is that rather than focusing on whether engineering sector will do well or let's say pharma as a sector will do well, I don't think we are looking at that sense, because if your overall global GDP growth is not going to be good, I don't think a sectoral be happening or sectoral inflection will happen going forward. It doesn't look like it generally doesn't happen. So now within that sector, you will always find some businesses who have created some specialty or some moat or some niche in their environment of operation. and you will keep getting those businesses. So, for example, let's say if we have invested into one agri company, right? Then what we are observing, I'm not going by as a recommendation, but what we are observing is that this company uh, uh, has been in agribusiness for last many years. For last 4 or 5 years, for a variety of reasons, like there is a one particular crop has failed, or there is some drought in some scenario, or they were developing new products in their category, and therefore we have not seen their growth over last 4 or 5 years. The company is good. The company has been making phenomenal profit every year, but because there was no growth, there is no reward in the stock prices. Now, when we see the balance sheet or you go deep dive into it, you find that the company has been spending phenomenal amount of money on their R&D, have spent more than 250, 300 crore of R&D over the last 5 years. So you try and establish a hypothesis that are they close to encashing their R&D development in terms of new products and uh, the new crops. And if you believe that yes, you are close to that, then you start investing into that. So that's the strategy which we want to apply. And internally, for every investment, what we do now, we believe that you have to really do a lot of homework, a large amount of work. You have to see all the surrounding impact in the business. But at the same time, we would want that the business now what we are investing should at least have a growth of around 15% kind of a revenue earnings growth, and the stock is available at really good valuation, whereby you don't mind buying the entire business at these valuations. And I think this is what will drive going forward. And you will probably see in the market exactly this kind of behavior, that you will find stocks which have given really good return. The stocks will be rewarded, probably may not be in the same way multifold in the past cycle, but will definitely be a better reward than the overall market.
So, would your view on PSU stocks, as it was like optimistic in terms of inflection point and growth, continue there that ways, or you are seeing that now you'll have to maybe again move back to the normal private sector, where obviously the ultimate objective is increasing shareholder value, and hence there was one opportunity in the last bull run towards PSUs, because PSUs are beaten down, and it was like because of many years of inefficiencies followed by COVID, and then that led to that one-time opportunity at that point of time. Or you feel that that's continuing?
So we are not really averse to the word PSU. I think the strategy will remain always very simple, that if I am buying a PSU, whether it is a PSU or a private, yes, you can understand probably. Today, there are a lot of PSUs who are very efficient, but still, if some investors would like to question the ability or dilute the efficiency part, but still, if you believe that this particular PSU, which is in a business, which is structurally very strong, and it has corrected from top, but the real revenue and earnings growth is going to kick in going forward, I don't think we would hesitate to invest. We would invest into it, because our belief is that at wherever there is a revenue and earnings growth and the stock is relatively undervalued, market will recognize it at some point of time. The difference could be is that in case of private businesses, maybe the reward could be little larger. In case of PSU, the reward could be maybe little less than what one would have anticipated if that business would be in the hands of private company or private management. But as long as balance sheet is good, you expect revenue growth, and there are few PSUs today are definitely having a great monopoly sort of a business in terms of their product, in terms of their engineering capability, in terms of their size. So when you put so many factors into it, the word PSU as a general term, yes, which people say that there has been a lot of run up and you may not get a return going forward. But I think our view remains that as long as there is a revenue earnings growth, market will recognize it. Sooner or later, it will recognize it.
Sure, Nilesh. The cash that you're still holding in, overall portfolio, which is around 45%, and you said that you have deployed around 7 to 8% in last, say, 1.5 months. So this 45% cash that you're holding, what is the timeline that you have kept for the deployment? Are you waiting for any specific events to unfold, maybe tariffs, confirmation, or this quarter earnings, or anything else which is bothering you? What is the reason and what is the timeline?
So honestly, we are not. We have started investing, and we are not really now waiting for any kind of a positive event to turn, because our view is, again, additional view which I haven't shared since we started discussion, is that world over, whenever the government will see their economics are in trouble, or it has some slowdown, they will, I am sure that they will intervene, and they will work hard to see that the economy is attempted to revive. Number one. Number two, from a national security point of view, you will see massive investment. Irrespective of Europe slowing down or Japan slowing down, there will be investment in certain areas of, uh, their requirement, which could be from a national security point of view. So, which could be infrastructure, which could be defense, which could be pharmaceutical, or which could be some kind of special capital goods, semiconductor, etc. So, you will have a short-term pain, and then suddenly you will see the government coming in, kicking in some kind of a reform measure to restart there. So, in a scenario like this, uh, the opportunity will keep coming into the market. So I honestly don't have a timeline, but what we are doing, this is so. This is the first, second part. The third part is that therefore, and third most important part is that at some point, once the US stabilizes on the tariff part, which they will have to at some point, because finally even US will need buyer for their treasury, and today 40% of their treasury issuances are bought by the foreigners. Therefore, we will see some kind of a balanced approach going forward, and thereafter, if geopolitical tensions, especially on the two between the two countries on the war kind of a scenario, if it dilutes or if it uh, brought down substantially, then all the governments world over will re-look at their economies to kickstart their economic engine. Currently, everybody is going through this kind of a turmoil and some kind of surprise issues like we have seen in India. But moment you come out of that, your parallel immediately the focus will shift to, now I have to bring back my economy, and I have to restart the growth engine. And therefore, we believe that keeping all this in mind, somewhere down the line, assuming something extremely unforeseen happening, as you rightly said, that nobody knows, like you define a black swan kind of a event that no one knows about it. But if everything is under control of man and everything is man created, I think some kind of a sanity may prevail on an optimistic view. And therefore, we believe that our ability to invest will be sooner. So I don't have a ballpark number that whether we'll invest in next 3 months or 4 months or so. But I think the way we are finding businesses after in all these kind of a volatility and turmoil, we're a bit comfortable that we should be able to invest relatively a larger sum in next 2 to 3 months.
Some of the reasons which were responsible for you to go on cash way back in October, are most of those reasons addressed in your mind, or you're still not comfortable? And if you have to quote a percentage, that this percentage comfort has come, but this percentage has still not come.
So, very tough question, because, as I said, economic slowdown will remain, but again, India will be a better economic growth than the whole world in a relative terms. A. B. Whenever your economy remains even in a growth path of, as I said, 10% nominal growth rate, There will always be some businesses which would be available. Okay. Now those businesses were available, probably one would argue then they were available in October, November also. You're right. But then if those businesses available, whatever point of time, if our hypothesis says that we are now close to the change in revenue and earning, then only we would invest into it. Okay. So overall, there is no major change in terms of happenings in the economy. There is no change in export earnings. There is no change in wage earnings. In fact, IT wage earning has even further slowed down. Overall, IT sector itself is slowing as compared to what we have seen in the last few years. So there is no really major change in the economic landscape, and especially on the P multiple and earnings side, because there is a slowdown in the earnings overall. But yes, there are positive changes in many companies, which is coming across after this Q3 and Q4 numbers, and especially Q4 is confirming in many areas that the companies, because of their own ability, because of their own certain product development, or because of their own readiness of their capex, which they have done in past few years, is now ready to grow, and that is the only strategy which you would like to apply.
Sure, Nilesh. So for everyone, because I can see a lot of people have sent me questions privately and in the chat box as well. We may not be able to ask all the questions. I am refraining to ask product-specific questions because we are here wanting to understand Nilesh's view. But you are most welcome to book appointment with us. You can discuss all product-specific questions one-on-one, because every product has a different I would say ideology, and every client has a different profile. I have already shared appointment link. You guys can come and book appointment with us. You're most welcome. Further, last 10 minutes of conversation, Nilesh, with you. While we know that yes, market is always giving us some opportunity to make money in blend of growth versus value. You mentioned that from top down you will be doing bottoms up, but I have interviewed many fund managers in the bottoms up approach. We have always felt that top down is something which has a potential to give very large returns, and which is what many investors expect now from Green Lantern, because you are responsible for having set those large expectations. But bottoms up, maybe investors feel that the returns will definitely be lower, but at the same time investors also feel that the drivers of maintaining a top-down approach versus a bottom-up approach are different. And correct me if I'm wrong, and you have to address this question. So it's like saying, when you have to do top-down, you're sitting in office, you have to do less legwork, you have to be more creating idea and understanding it by reading journals, that this is where world is headed, and that is how you assessed and invested in power, infrastructure, defense, PSUs. But now when it is bottoms up, you have to do a lot of legwork in terms of understanding bankers, maybe competitors, suppliers, because it is bottoms up. And you are a boutique company, with a limited team, and obviously competing in the entire industry, where everybody says we do bottoms up, and where they talk about we have 20 analyst team for 40 analyst team, right? So how will you kind of align in between this when you are saying yourself that maybe now market is more conducive for bottoms up and not for top down?
I think market is more conducive for bottom up is the pattern which you are already observing, because I don't think that there could be one or two smaller sectors can always do well, but those are not going to be a very large biz sectors like say IT. I mean, IT as a sector is a very large sector. So as an entire sector, I don't think IT is going to give you those kind of return. Therefore, what you need to find is one company within the IT sector which is doing differently and will grow in a very different way, and which is available at probably a multiple which people have ignored it. So the difference between top down and bottom up is only that top down, your effort is to identify the sector as a whole, and are there many tailwinds or many kind of tentacles which are becoming positive for that sector, whether from the government, whether from export, whether from domestic demand, or so many things. In case of bottom up, yes, the effort and approach is going to be very large. But having said that, I think you made a very interesting point on the number of analysts. So then, my question to you rather, because you have been meeting so many fund managers in this entire country than me. If that is the case, why all these large mutual funds or PMSs who have a team of 10, 20 analysts and a kind of large expenditure on that side, which is not important, but large team and really very experienced team, then are missing finding even top down when the cycle was very favorable on the top down. Okay. So answer to that is that we as an internal three people, we have collectively a very large research experience. We all come from actually a research background. And therefore, we believe that our ability to understand a value chain of every business is, we feel so, that is much better actually. And every business to analyze in terms of the value chain, the starting point, the end point, the consumer, the competition is much better than or much faster, I would say. That is one thing. Second is, I mean, generally, since I come from a sell-side research for last 20 years before starting this business, I think the larger money is generally not made in top-down. The larger money is always made in the bottom-up. The bottom-ups give you, even in a top-down approach, you have to have a very strong bottom-up within the top-down. And so give you some example that when the chemical cycle turned, let's say in last 2012, 13 onwards or 14 onwards, if you would have taken up a company X versus, let's say, people have bought specialty businesses like SRF of Navin Flooring, then somebody has to go deep dive into that entire sector and say, okay, I am positive on the sector, but in the entire sector, these are the two businesses which have a much different and better specialty than anybody else. And then those stocks have given 100x or 80x return. So net, whether you do top down or bottom up, your learning curve starts always from top down, but your ability to identify those bottom up businesses, which requires a lot of experience and skill. And this is what, and plus continuous learning. I mean, experience and skill is have to be added all the time. And I think we follow that practice very deeply. All of us spend a lot of time. And then having said that, in terms of support, we have also started adding few analysts. So we have added one. We are on the verge of hiring another two. So that process will continue, because as your size grows, you also need a support to do a lot of mathematical modeling, which we do ourselves. Now we need somebody to do it. So all that we will definitely continue to do that. But I think our experience is that we collectively cover every sector, and our understanding of every sector is better and faster. And if we miss something, we will always learn, because that's the approach you have to have. You cannot be you cannot be complacent and say that, oh, I know everything. The market teaches you every day something new, and that we are prepared to learn on an ongoing basis and on a real-time basis.
Absolutely, Nilesh, bang on. So, we really wish you good luck, and I know experience and skin in the game is far bigger than I would say the other approach of having maybe multiple analysts, and the thing speaks like numbers. And we at PMS AIF do a lot of objective evaluation and do a lot of, I would say, analysis, not just on past performance, but a lot of other risk measures as well, consistency measures as well. And that is where I kind of always say to everyone who watches our webinars, it is not as easy to make money by just knowing the product. It is very important to understand it kind of in depth, and it is also important to be in that product with a lot of conviction and understanding. Hence, both wealth manager as well as good fund manager are important. Last 2 minutes I will take from on behalf of our clients who are already invested in Green Lantern. Clients, because they see that yes, Green Lantern has done really well and it took cash call at right time, and that increases the, I would say, further confidence of the investor. He's sitting on liquidity, but he sees that you're also sitting on liquidity, and now he's wanting to understand, shall I do a top up now in your investment? Because I find if I have to deploy my money in equity, versus product A, B, C, I know clearly Green Lantern is a product where I want to do. But because you guys are sitting on liquidity yourself, he's like holding back, and then if that takes longer, that money moves somewhere else, and then eventually, investor realizes that I was maybe impatient in deploying this money in something else. I should have idly invested in Green Lantern. So, what is your answer to that? I would say practical ask from the investors.
So my answer is very simple. That as a fund manager, we would be extremely cautious about the capital protection, which is always be the denominator. And on top of that, we should be working very hard to find great businesses at a very favorable risk reward, and that effort will continue. The learning in this market is something which I'm sure all the investors who are listening to this discussion is aware that in this market today, the number of participants and number of investors, HNIs, family offices, and mutual fund, PMSs, everything is large and is growing. Therefore, what we are observing is that if you have figured out or found a business which you like to invest, we have seen that the stock runs up so fast once the numbers or revenue or earnings growth kicks in. And therefore, the window of investment really many a times becomes very smaller because you miss the opportunity at a very fast pace also, which is happening on the downside also. Because once a stock underperforms, even the downside fall is equally very fast, and it is not allowing people to have an opportunity to exit. And then by the time they really conclude that these numbers are not going to improve going forward, it's many a times too late to get exit, especially if you have a very large investment and large quantum of stock. I mean, in terms of percentages or in terms of the number of shares. So this market has taught something very new in this particular cycle, is that both on the sell side as well as on the buy side, you have to be very agile. And therefore, the only suggestion which we do to our investor is that if you believe that going forward what we say makes sense, and if you feel that yes, what we are probably doing is going to be different and can generate some alpha or better return, I think one can start looking into investment depending on their risk appetite.
So clearly, you're a conservative fund manager in everything and anything that you do and say, and that's something which is, I would say, your trait. That it's a blend of being conservative as well as obviously alpha focused. And thank you for your time today, for sharing your thoughts, and thank you everyone for joining for this Friday webinar. Thank you everyone.
Kamal, thank you so much, and thank you to your team.